Now the next concept is about issue of debentures as a collateral security. When the company takes loan from the bank or the lender will insist on security being given, obviously. So the company will offer some asset as primary security. Now the lender is not very confident of the realizable value of the asset which has been given as a security. So the lender may demand for some additional security to the primary security, so that the lender will keep it as a buffer in case if the primary security is not sufficient. Then the company can make use of the additional security which has been given. So that is what is called as collateral security. So we are now going to discuss about issue of debentures as collateral security. Issue of debentures as collateral security. So when the company takes a loan from financial institution, the lender will demand for security. The company will offer some asset as a primary security. The lender, if he is not satisfied about the value of asset which has been given as a security, the lender may demand for some additional security being given. The company, instead of offering any other asset as an additional security, the company will issue certain debentures as additional security. Please remember, they are only additional security. So, the debenture certificate which evidences certain number of debentures being issued at par or at premium, whatever the case, serves as a document that the company has submitted to the lender as additional security. The value of that additional security arises only when, number one, the company defaults to pay the principal or the interest commitment. Number two, the primary security which has been given as a security is not sufficient to meet out the interest or the principal commitment. Only then this additional security which has been given by the company comes into picture. Until then, it is only a paper in the hands of the lender. The document stands cancelled automatically in the event of, number one, the company meeting out its principal or the interest commitments promptly. Or, number two, the primary security is sufficient enough to cover up the interest or principal component, in which case the necessity for the collateral security does not arise at all. Therefore, no interest is payable. Please remember, no interest is payable on the debentures which are issued as collateral security. So, no interest is payable on the debentures which are issued as a collateral security. The company is under no obligation to pay interest on the debentures which are given as a collateral security. It has to pay interest on the loan that has been raised by the company. No doubt at all. If the company has issued debentures for cash to the general public, for them interest has to be paid, but no interest need to be paid on the debentures which are issued as a collateral security. Why? They are only additional security given to support the primary security. That's all. Now coming to accounting treatment of debentures issued as a collateral security. Now there are two methods of dealing with debentures issued as a collateral security. Now the first method, in the balance sheet, of so and so asset. So we are preparing the balance sheet. In the notes to accounts, so first in the balance sheet, under non-current liabilities, you will be mentioning about long-term borrowing and note number 1, and you enter the amount. Now come to notes to accounts. Notes to accounts is mandatory to be prepared by any company to be submitted to the annual general meeting, which gives details of the information that is furnished in the financial statements of the company. So in notes to accounts, we enter long-term borrowing, bank loan, within bracket, secured collaterally by the issue of -% debentures of -each. So, mere mention in the notes to accounts is the only accounting treatment required in the first method. So, in the first method, we are preparing the balance sheet. In the balance sheet, long-term borrowing, we are entering the amount and mentioning in the note number. When we go to the note number, we will know that the description is being given. Description of long-term borrowing as bank loan, within bracket, secured collaterally against the issue of -% debentures of -each. So, you are informing the shareholders that the company has issued some debentures as collateral security. So, their issue is being recorded in the books of accounts only in notes to accounts. Otherwise, it has no effect in the balance sheet. The accounting treatment number 2. In the second method, there is a journal entry. We are going to create an artificial account called debenture suspense account. Then show the effect of it in the notes to accounts. Again, mind you, no effect of it is felt in the balance sheet of the company. So, in the second method also, the balance sheet will have the same information. Balance sheet of so and so as at. So, no change in the balance sheet. So, you write non-current liabilities. In that, again you write long-term borrowing. Note number, then you write the amount. Now, we shall be passing journal entries and showing the effect of it in the notes to accounts. What journal entries are we going to pass now? Entry number 1, bank account debit to bank loan account, loan raised or loan borrowed. The second entry, we are creating an artificial account called debenture suspense account. Debenture suspense account debit to -% debentures account. Debentures issued as security. debentures issued as collateral security. We pass the journal entries. Now, how are we going to show in the notes to accounts? Long-term borrowing. Long-term borrowing. We have bank loan as usual, and within bracket secured collaterally by the issue of dash percent debentures of dash each. Then next one we are writing dash percent debentures, some amount, less, debenture is nothing but the face value of debentures which have been given, less debenture suspense account. Debenture and debenture suspense will have the same value, and in the outer column you will show it as nil, but you are bringing in the debentures under specific heads. That's the difference between the first method and the second method. So in the first method, we recorded debentures as a footnote, that's all. So we just showed it in the balance sheet, and we just mentioned a bank loan in the balance sheet and showed it in the footnote. Whereas in the second method, we created an artificial account called debenture suspense account to record the issue of debentures. So we passed journal entries for availing the loan and for the issue of debentures. So we pass the journal entry as bank account debtor to bank loan account, and the second entry is debenture suspense account debtor to debentures account. So in the notes to accounts, we had bank loan within bracket secured collaterally against so and so, and debenture suspense account is also brought into books. So that percent debenture liability is created, and that is settled against an artificial account called debenture suspense account. So that percent debentures less debenture suspense. Ultimately the effect is the same, that you have a nil balance only. So nothing is reflected in the balance sheet. Ultimately in the balance sheet, whatever is the mortgage loan or bank loan that has been availed, only that amount will be done. So this is how in the books of accounts, debentures issued as a collateral security are being recorded. In the next session, we shall be discussing about the recording of transactions under redemption point of view and the interest payment, debenture interest, concept of periodic payment. Namaste.